Okay, we're ready for the fireside chat. We are extremely happy that we have the moderator from the markets with us, Georg.
There are many Georges.
Gregor, sorry.
Almost an anagram.
And we have our visitors. We have Jay from the US.
Hi there.
And we have Beltran from basically Azvalor.
Good morning, everyone. Thank you, Alex. I'm thrilled to be here.
We are absolutely pleased and happy to have you here.
So thank you, Alex.
Gregor.
Good morning also from my side. After hearing what you presented so far, you know, there's a strong case now that this value cycle, this value outperformance has started. But you know, so far, obviously, all these kind of outperformance blips were rather short-lived, at least on a global level. And my impression is now, you know, that despite all these good arguments, actually the momentum trade is catching up again. Technology is catching up again. Despite actually also many of the arguments we discussed last year, like interest rates are high and so on. And still, you know, it looks, to me, it still looks like a bit an unstable basis for this value outperformance to really happen. So what makes you so confident that the momentum trade is dead and probably what is needed, you know, apart now from what you already presented, that value really starts to take off? And I guess because I think it's an important question, I think we go through all of you.
Maybe I'll start because I'm the the lone American on the panel. I mean, one of the things that I think about, there was a chart recently put out by a guy by the name of Howard Marks, which I'm sure that many of you guys in the audience are aware of. And he put out a chart that basically showed that historically, over the last like 30 years, the price that you pay for the S&P 500 index, the going in PE, plays a significant role in the future 10-year returns that you'll ultimately generate. And he showed this chart that showed that if you buy the S&P 500 index in the United States at 14 or 15 times, you can expect very good returns in the subsequent 10 years. But what he also pointed out is that when you buy the S&P 500 index historically at 22 to 23 times earnings, which is the forward earnings estimate today, historically, what the data has shown is that in the subsequent 10 years, you earn approximately minus 2% to plus 2%, so effectively zero. So we're sitting here right now, it's 2025. I would predict that in 2035, 10 years from now, in the United States, we're going to be talking about a lost decade where the returns of the S&P 500 have effectively been flat. That's my core belief. Another thing I want to point out, a lot of people like to talk about American exceptionalism and that some of the greatest companies are based in the United States, and the companies in the United States maybe grow a little faster or have higher returns on invested capital, but they're priced for perfection. And part of American exceptionalism, to be quite honest with you, is massive fiscal spending, massive budget deficits that are unsustainable. Okay, so if in the last 4 years, I'm going to throw out 2020 where there was big fiscal spending in order to save the US economy. But from 2021 to 2024, the United States has run annual budget deficits that have averaged 8.5% of GDP. And that's unsustainable. And it's been a huge tailwind to earnings growth in the United States. And it's unsustainable. It has to end, and it will at some point.
Oh, yeah, probably I give the chance to everybody, but just one remark from my side. Obviously, this valuation argument has been there for a while, that US equities are rather too expensive and future returns will be low, and so far, obviously, it hasn't really played out, but yeah, probably with it.
Little to add, I mean, I fully agree with what you just said, but I think perhaps a different emotional approach to investment is needed from the investors. No? If when we buy a component company at a 17, 18% return, we really don't mind what the stock exchange says, you know? We don't want to sell it. We want to hold it, you know? And so we follow very much how much return have I done on the fund, you know, that has crystallized. We don't care. Our clients care, and that's why we select and we tell them clearly, this company is working, but it may not yield in the market. But why do you want to sell it? If it's the right company and it's creating value, and you know, Warren Buffett got on dividend last year, Berkshire Hathaway, more money than he invested in Coca-Cola in a single dividend, you know? So sometimes we talk about markets, we talk about alternatives, ETFs or whatever, S&P, and I think that's our aim to be always winning. And we consider we don't want to be winners all the time. We want to have safe assets that compound, that protect our money, and hold them as long as I don't have an alternative which is better than that one. You know, if you go with this attitude, you know, then value always works. I believe value always works.
And I would actually add exactly to this point. I mean, in the first Swiss Rally Day, we had the sausage skin producer from Scotland coming here. There was one analyst following the company who could say, who is going to build up the price? 4.5, 5 months later, the company was taken private by a German family with a 65% premium. You do not need Mr. Market to wake up all the time. And, you know, we had a crying eye because it was a kind of fair price, but we had to find a new idea. So, you know, I mean, it's of course, we are trained to perform well, short-term, et cetera, but I mean, 10% over the last 14, 15 years, as Marcus showed, is it so bad? I mean, I have to pay the school of my kids and the ski lessons or to the ski camp, et cetera, et cetera. So, you know, I think it's not so bad. And I'm pretty sure that the momentum will turn because valuations are stretched. I mean, yesterday I checked MSCI World. The largest position now is Microsoft, trading at 37 times. I mean, I still remember Gary Brinson coming to Zurich forbidding everybody within UBS to own Microsoft because it was trading at 40 times. He was not saying that it's a stupid company, and the company performed extremely well, earning-wise, from 2000 to 2011. But the PE of Microsoft fell from 40 times to 9 times in 2011. And I had a big fight with Carlos internally, why don't we only buy Apple and not Microsoft as well? I think, you know, we are in cycles, and I mean, if you tell a young kid, I mean, somebody that started finance industry in 2011, that you could have been able to buy a Microsoft at below 10 times, and he was just starting after that, he will not realize it.
Okay, so I'm going to repeat all of the arguments.
The last one is always difficult.
No, so you've heard all the arguments for why value should outperform, but for us old people who remember the internet bubble bursting, it didn't happen overnight. Mm-hmm. This is a slow process. So I don't think it's completely crazy to say it's not happened yet. But I think we're confident that it will happen. And even if you don't believe it completely and you think that, well, gosh, it really is a great idea to own expensive companies because they're so good, maybe it's not a terrible idea given the risks that are out there that we've all discussed to have some of your portfolio in value too. And I think if just a few people have that thought, you know, of the big asset allocators, that's going to make a huge difference.
I'd like to make one more comment too. I'm sure many people in this audience follows David Einhorn. And David Einhorn about a year ago penned a piece and it talked about how passive investing and index investing now represents over 50% of stock market trading activity. And originally, the whole idea of an index was to piggyback off of the work of fundamental investors, right? That are paying attention to what companies actually do and what they actually earned. And so the fundamental investors were really the price setters and the index were price takers, effectively just piggybacking off of active management.
Right.
And that, there's been a tremendous mix shift to where now greater than 50% of the market is run by passive indices. And that's created a whole universe of investors that are valuation indifferent, that are valuation agnostic. They don't even know what these companies do. And that's led to overvaluation, in my opinion. A lot of these European markets, it's the exact opposite. There have been negative outflows. There's people that in this audience that probably know this. In the UK stock market, in the last 47 months, there are 46 of those months have had negative outflows in equities, right? So the exact opposite of the positive inflows into indexing in the rest of the world.
What makes our life easier?
Right. Where are you more likely to find a bargain?
Obviously.
I'm asking the audience, where would you be more likely to find a bargain? Where there's positive index flows that are driving stock markets up and overvaluation, or would you be more interested in an area where there's negative outflows, forced selling, creating opportunities? Warren Buffett talks about looking where there's less competition, and I think there's less competition today in value stocks, and particularly in international value stocks.
I have a question.
Do you know how much of the other 50%, how much of that is algorithmic trading? Because I've never seen any good statistics, but my gut tells me a lot of it.
Yeah.
It's huge. It's a huge amount because you see.
That's right.
And the algorithmic trading just goes by simple rules. Usually they're momentum rules. So that, to get back to your question, that could be what's happening now, is that once tech started picking up again, you had to buy it because that's what your computer said you needed to do. And what I'm hoping is that there's a couple of people out there who've also programmed value rules into their computer. And I think there are. But the amount of people that, like us, who value companies by looking at them in detail, just become a very small part of the market.
And they're getting old.
And they're old.
Probably, back to that, I think all of you have said before that you feel pretty confident. You buy great companies at good prices and you just wait. You have patience. But, to what extent does that also apply to your client side? Because I guess there it might be a bit more difficult. Do they really have the time and patience and wait until this undervaluation disappears?
We've got a strong base of clients, individuals. Most of our clients are individuals, retail. They tend to know less than institutionals. And we address this point by incentives. No one at our firm is incentivized by attracting money. What we want is long-term investor alongside us who assume the decisions and they assume the risk of laying the money on our funds. So we make very clear, then don't come if you're not ready to suffer, because you are going to suffer. It's like playing rugby and coming back home clean. It's impossible. You haven't played rugby. So by setting up incentives of being honest, explaining on the right time the right things, and psychologically speaking, being accurate with your clients, we have sort of built up a franchise where our clients immediately come to visit us when there's huge amount of pain. For instance, last month, we went down 15% in our fund. Many may believe that the money will flow out. We had unsolicited 40 million euro coming in. We didn't call anyone, but they knew that when tough times comes, we're prepared to buy bargains and create value in their money. So clients, I'm a client myself, we are the largest investor. They tend to say that they're ready. They're not really ready because all the crises are different, and the primitive part of our brain tell us sell, escape from this. So Kahneman explained very well on Thinking Fast and Slow that you need to activate the rational part of your brain, the part 2, to say, well, as Marco was saying, if you buy IRR at 17, it goes to 25 because it dropped the business, the price, and the business is the same, it's time to buy. No? So it is difficult. I think the industry is designed in the opposite way that we're trying to do it, but you can achieve it. No?
Probably I could also ask the question from the other angle. Do you already see inflows again? Because that would probably be the clearest sign that this time the value cycle kind of really has legs. Well, yeah,
I mean, I'll speak first. I mean, we haven't seen positive inflows yet. I mean, I think we've had negative flows, and it's a couple of years. But I think what we try to do is educate our clients that look, there's two prices to every stock, right? This is what Ben Graham taught us. There's the price that you see quoted in the stock market every day, and then there's the other price, the intrinsic value of the business. We define that as what would the business be worth if 100% of the company were sold, and we try to exploit large gaps between those two prices. We also tell clients that when they sign up, are you prepared to accept 3 straight years of underperformance? Because that can happen. Value goes in and out of style. And unfortunately, this last string of underperformance has lasted about a decade. So it's uncomfortably long. But maybe the final point that I would make is that Tweedy Browne manages $7 billion. You made this point. 1.6 billion of the money is the principals and family members of the people that work at Tweedy Browne. So our money is invested right alongside our clients.
And you sleep well when it goes down 30%. No?
Absolutely, because we know what we own.
We are not seeing inflows yet. I think that it's going to take, as a realist, I mean, first of all, you have to bear in mind that all mutual funds have a natural level of outflows that, especially when we're also a retail product, that just occur because people, this is people's personal money, so some of them die, and then their heirs don't want to invest that way because they'd rather do other things with the money, or people say, okay, I need the money for something else. So you're always going to have that sort of demographically driven level of outflows. And to get the inflows, to be honest, a fund like ours was going to have a year or two of good performance because we've had such a terrible stretch of bad performance behind us that nobody really believes us. I'm glad you're all here to listen to us. You've read the disclaimer. Everything I've told you is a lie. And I think that's the attitude. That's the attitude of most people. They're going to want to see the good performance. And the sad part about that is that's when the easy money has been made to some extent, when it's already a little harder to find the arguments where you don't like, oh, it's so cheap, please buy. And that's sort of the situation we've been in. As the PE of our fund has come down, we're like, guys, come on, buy. But they don't, because the PE keeps going down. So. Well.
In our case, we were a bit luckier in the sense that with this rebalance we were able to do in the COVID low. After 3 years in 23, we started to see some inflows. It's exactly what Georg is just saying. I mean, you need it's a past performance of the last 3 years. Now somebody found out in DAS Investment in Germany, we were #1 over 5 years, over 1,476 stocks, and suddenly people call us from Germany. But our real clients, to go back to your previous question, are family offices. The closer we are to the entrepreneur, the easier it is to explain that we like to buy a house at 100,000 and not at 1 million if it's worth 500,000, as Marcus said. And it's the same with us, like ourselves are percentage-wise the same amount invested in the fund, but not the assets like Tweedy Browne.
Let's briefly stay in the US before we move to Europe. But I wonder, and again, I guess from all of you, the whole noise we now have politically, tariffs and also all the rest, this kind of uncertainty that the current government causes. To what extent does that affect your discussions, your stock picking?
Yeah, I mean, it does play a role in stock picking. I would say the vast majority of the companies that we own have a small, most of them are producing in the same country as where their consumers buy the product. And so for the vast majority of the businesses that we own, the tariff impacts seem very manageable, at least the direct impacts. It's the indirect impacts, right? The second order effects that could lead to a possible recession that I think are more worrisome. I can tell you this, that the way, Mr. Trump is somebody who's very mercurial, and his views change almost daily. But the way that it's explained to the American public, the main two reasons for the tariffs are A, to bring back or to reshore manufacturing into the United States, that's one. And number two is to help the United States pay for these massive budget deficits that we've been running. And Trump likes to tell the story that it's going to be the foreign countries and the foreign companies that pay for these tariffs, not the American consumers. That's a complete farce. It's a complete farce. Every company that I talk to, when they talk about ways that they're going to mitigate tariffs, ultimately it comes down to they're going to raise prices, and it's the American consumer that's going to end up paying these higher prices, and that's going to lead to higher inflation. I can also tell you that the other reason, right, is this concept that the tariffs are going to bring a reshoring of manufacturing to the United States. Look, guys, it's not happening. I speak to all of our companies. Boardrooms today, instead of thinking about how are we going to increase our competitive advantage or really grow our business, they're thinking about how to game the tariffs. How can we rearrange our supply chains to effectively game the tariffs? And nobody's making an investment decision to bring back manufacturing to the United States today. No boardroom is seriously considering that because it would take multiple years. There's a lack of employees that would work in these factories. And the minute that it's built, we could have a new Congress or a new president who changes the rules, and all of a sudden this brand new shiny manufacturing plant in the United States is a high-cost producer. So ultimately, I think we were all trained. There's a reason for comparative advantage. There's a reason for countries to do what they do best and not try to be completely self-sufficient in everything. And ultimately, I think greater heads are going to prevail. I'm one of these people who believes in, you guys have probably heard the acronym TACO. It's something that's been talked about in the United States. TACO stands for Trump always chickens out. When it comes to actually implementing the tariffs. And my personal belief is it's a negotiating ploy. I think there is a strong desire to implement tariffs on China because we do think the trade practices in China have been completely unfair, and the companies benefit from government subsidies that don't enable free trade. And there may be a few industries like semiconductors, pharmaceutical manufacturing, steel manufacturing that are truly fundamental to national security. So I could see tariffs sticking there. But the broader tariffs, the so-called reciprocal tariffs on the EU and the rest of frankly, I suspect we're going to have deals, and those are going to go away.
Well, uncertainty, it's a humankind characteristic. It's intrinsic. No one knows what's going to happen. But we've got the fake dream of trying to live in a certain world. It's impossible. So we love uncertainty because it's intrinsic. You cannot destroy uncertainty. And we love it because uncertainty has a deep impact in prices. And when it's unanimously perceived that uncertainty is a negative thing, prices depress.
Yes.
And so you cannot say what's going to be the outcome, but it's certain, thanks to the uncertainty, and sorry for the game of words, that the outcome, the price discount on that asset, it's impossible.
Yep.
You see what I mean? So we love it. We love uncertainty. We love Mr. Trump, not because of his political thoughts, it's because he's turning up and down everything. And he's giving us the chance to buy assets that we believe will survive Mr. Trump, because they are needed. They're not good businesses, they just need it. The world cannot live without them. We invested in uranium 8 years ago, when the certainty spread around civilization was that was not needed. So they were quoting at the price that it was impossible. Unless you find an energy source that could substitute atomic energy, on that net zero dreams of. So that uncertainty that became certainty, that nuclear power is not needed, drove us to invest into a certain investment that we made a lot of money. You had to have the stomach to cope with everyone against you, until Mr. Macron and the guy at Microsoft, Bill Gates, said it's needed. So we pray that we have more uncertainty. We're sorry about people suffering from it, but it's a good advantage for us.
So you mentioned that you bought during the Liberation Day panic.
Well, that's an anecdote. I mean, we bought certain companies that day, because of whatever reasons, went down. We don't know if it was Liberation Day, Mr. Trump. I mean, we tend to talk about politicians and macro geopolitical, but no one talks about the CEO role, the governance, your competition mode, how smart you have reinvested your flow. What are you doing to increase your competitive advantage? How do you remunerate your shareholders? I mean, no one talks about this, and this is what really matters in an asset. Mr. Trump comes and goes. We don't care about them.
On your side,
one of my cheapest and most frustrating stocks is Kelly Services, which is a temporary employment agency like Adecco. It's purely US focused, and so of course if there's a recession or all that kind of stuff, that'll hurt them. But they have a pretty good balance sheet, it's clean. They're trading at 4 times EBITDA for an industry where 8 times is cheap, and sometimes it goes up to 12 times. So it's incredibly, ridiculously, stupidly cheap. And what doesn't matter is what happens in the next 2 or 3 years. Yes, earnings might go down. Maybe they won't, maybe they will. We don't know. That's the uncertainty you were talking about, Beltran. We just don't know. But what you can be reasonably confident is that once we get through the bad period, the average earnings over the cycle are high enough that the company is just, you just have to own it today and then wait. And that's value investing. If all of us were rich enough to buy the entire company and we could do it today, we would. It's so obvious. The stock market's not doing it, but for all of us here, it's like, yeah, of course. Then we wait. So as you said before, it does offer opportunities in the sense that some things just get way too cheap because the uncertainty looms so large in people's imaginations.
Absolutely. I mean, this uncertainty is fantastic. And then if you then are even able to buy a company that has great moat, a fantastic pricing power, that is strategically in an oligopolistic market, hey, thanks a lot, because these guys will bring through higher prices, even with tariffs. So you even have winners in this circumstance.
Yes.
And what's clear, I mean, we have not talked about commodity too much, except uranium. I mean, we were buying exactly the same when uranium prices were at 15 and 30% of the capacity was taken out of the market because it was not sustainable by 50% of the 2 players. And after multiplying by 6, everybody was crying, uranium, uranium. It's the narrative. It's the narrative that brings the markets. And I mean, sometimes you just believe it cannot be so simple. But if you really follow the long term, it pays.
So you all mentioned that you kind of bought or find more attractive opportunities. So is there a name you bought during this Liberation Day or Trump panic?
I mean, of course, what we really like to increase was basically some oil stocks. I mean, we have a company in Norway that pays 15% dividend yield. And it's one of the few oil companies still producing in the North Sea. And we increased it. Because, of course, whenever there is a recession fear, all the macro traders, all the CTAs go short oil. It's absolutely no immediate reaction. I think in the meantime, it's algo trading. It's a machines, AI-driven selling of oil.
Yeah.
And of course, I mean, if oil prices then fell to 55 or something like that, And we know that, for instance, the CEO of Occidental Petroleum mentioned in Davos in 2024, we're going to have an oil crunch, either 25 or 26. I mean, who is right? The CTA trader that just sells because the moving average of 200 lines is broken? Or maybe 60% of the oil production that all basically say we are crazy because we all dream about ESG and we are in the middle of the river, taking down the bridge, and we are looking at each other, how do we get on the other side of the river?
Do you want to mention the name?
Yeah, sure. I just want to reiterate, I've heard this a couple of times today, you can't have a bargain in the absence of fear. Somebody had the quote earlier, it's Buffett's famous quote, be greedy when others are fearful, and fearful when others are greedy. It's so important. It may be the single best investment advice that I take away from Warren Buffett. We own a business in Canada by the name of Winpack. It makes plastic packaging primarily for the food and beverage industry in the United States. So greater than 90% of the sales come from packaging. Their big product is bacon packaging, believe it or not. So in Canada, they produce 100% of the bacon packaging that you would buy at the grocery store. In the United States, they have 60% market share in bacon packaging. But it's a company with a fantastic long-term track record, based in Winnipeg, but 80% of the sales are actually derived from the United States. So this was a company that manufactures primarily in Canada and sales into the United States. And so if there were significant tariffs, this company would be disproportionately negatively impacted. And when Trump first introduced tariffs that related to Mexico and Canada, these were the so-called fentanyl tariffs. I don't know how closely, but effectively he said these tariffs are about drugs coming into the United States and leading to this drug problem. And it was really China, it was targeted at China, Canada, and Mexico. And then within a month, Trump got rid of these tariffs. And the reality is that there's a trade agreement in the United States with Canada and Mexico. It's called the USMCA, or the US, Mexico, and Canada Trade Agreement. It's the replacement to NAFTA, but there are exemptions. And this company's products 100% qualify for the exemptions, so there are no tariffs. They're not going to pay 1 cent more from their manufacturing in Canada and sales into the United States. But the fear of that risk took this stock from the low 50s to the high 30s, and we pounced, bought more stock. We were able to buy stock at 6 times EBITDA, where if you look at comparable companies when they've been acquired in M&A deals, the multiple is 10 times. So it's like your house analogy. Here's a house for 6 times EBITDA. We're very similar houses, and there's 10 different transactions that are comparable that were sold at 10 times. We felt that was a fantastic opportunity.
Well, Alex said that the people just click on the selling on oil, and certain oil-related business leverage were massacred. That they dived 50%, 60%, and that's the oil platforms, which is not really an oil business, it's a real estate business. You know, these animals are, cost 800 million euros to build up. The market has concentrated after the COVID-19 because they struggled to survive the high leverage like any real estate business. And the offer has diminished dramatically. But if you go into the production wells in the world and the reserves and the discoveries, it's pretty clear that they are going to be needed. But the market played a short to them, and they went down 50, 60%. Some of them who are incorrectly financed, that to leverage, may suffer a lot. But those who are that have a good balance sheet will do well, and they went down the same. So we took opportunity to buy at a third of the reposition cost of this platform. So the question is this platform going to be needed in the future or not? what they produce with this oil is going to be consumed, yes or not. If the answers are yes, then just check and cherry pick the good ones. No? It's dangerous. It's a danger game. It's a danger game. Yeah?
I guess we have about 10 minutes to go. I don't. Oh, okay. So then I have to move over briefly to Europe because obviously, you presented the case for European equities, and yes, year to date they have been great performers, especially some markets. And yes, there were some reasons for it, like the change in German politics, probably also Trump kind of unifying the EU. But what makes you confident, Georg, that so far, I mean, what we heard are just words, promises. We will spend 1 point whatever billion. So far, I think no euro has been spent. So what makes you so confident that this time, this really works? Europe is really, or Germany is really kind of taking off.
Oof, I don't know more about German politics than you do. I think that they said they'd do it, and they should do it. There's every reason to do it. So they should, they need to spend more on defense. It's obvious. You look east, we need to spend more on defense. It's not really something we can talk about much, even though we do in Switzerland. There are many of us who still don't believe that we need to do more for our defense, but whatever. So I think the spending will happen for the simple reason that we're all kind of scared of what Mr. Putin might be planning on next. And he said he wants to keep going. That's not a secret. So from that point of view, I think they will spend the money. And then, again, I'm saying that's just one element of what makes Europe attractive. The other elements are, in particular for us, is just a lot of cheap companies that are good companies. Cheap and good companies, and if people start to rediscover them for all these soft factor reasons that we discussed before, what did I hear the other day? That brokers, I saw a broker's note saying, I've been asked recently what in this sector might be interesting in Europe. It was directed at American clients. That people are saying, that American brokers are telling American clients, listen, on the other side of the Atlantic, there's some really interesting stuff. I know you haven't looked at it in many years, but here's how we can help. So, that's another anecdotal piece of evidence that says that people they're starting to pay attention again. And so even if the Germans spend it more slowly or something like that happens, I think there's enough reasons to be positive, just because of the valuation. These companies are cheap. They get bought out, some of them, if there's no family controlling.
I wonder how what's the American point of view on that? Do you believe in Europe?
Yeah, I actually kind of have a funny antidote here. So, most of my friends that I know in the value or in the investment universe are value investors who believe like me, who ultimately believe there's a distinction between a great business and a great investment. And that distinction is the value that you pay for a business. I've got my son, 17-year-old son, who's sitting in the back of the audience. Since the day he was born, I've invested, in the United States, there's something called a 529. It effectively allows you to invest money every year into your higher education, so to basically prepay for your college, and you get tax advantages. The gains that you generate over time are not taxed, and so it's a tax-efficient way to invest for college. I have 100% of my son's 529 investments in international stocks. And they're not even in Tweedy stocks, because the 529 plans, I can't pick the Tweedy Browne funds. I'm given a list of sort of plain vanilla funds, and it's all in international stocks. But what's funny to me is we have lots of European clients. European clients call us and say, we want more US exposure. Give us more US stocks. I find that completely ironic, that the Europeans want US stocks and US dollar-denominated assets, and myself and the other people that I know in the investment industry want to get more money invested into Europe.
Robert, last word.
Now, a lot of people will smile because I tell the story all the same time. I mean, I have 3 boys. I get 200 Swiss francs kids allowance per month from the canton Schwyz, or 230. On a monthly basis, that goes into the classic fund. And the 14-year-old has now 65,000 Swiss francs in his UBS portfolio. But guess what? UBS forced me at the beginning that the newborn is not able to digest the risk of only being in equities. So I had to fight with them that who has the longer time horizon than a newborn? I mean, what is the alternative? But going back to the political question, I mean, on our side, we try to avoid as much as possible politics in our investments. Now, it's never be really possible because you try to hide in salmon farming and then they become so profitable that they are extra taxed again and again. But we really try to find places where politics does not make such an important role. For me, the big thing in Europe, why in addition things are really inexpensive, and you see that even between Switzerland and, let's say, Germany has a difference. German pension fund has an average 6% invested in equities. And the rest is government bonds. I mean, that's crazy. And because this buyer is missing, relative to Switzerland, where 40%, maybe 45% are invested in equities, that makes already evaluation different. But even more important than that is some European rules, like MiFID, which forces us to pay for research, which leads to the fact that a lot of our companies are not covered any longer. So I'm absolutely certain in 10 years from now, people will write studies and books about it was so clear that stock picking would come back because nobody was looking at it.
Less competition. It's a great point.
That's competition.
I think that's a nice last word. Thank you.
Now we have break.